South America should be rich. Genuinely, embarrassingly, obscenely rich. The continent holds nearly a third of the world's renewable fresh water. It has lithium in the Atacama, oil under Venezuela, iron ore and soybeans across Brazil, and copper in Chile. And stretching across almost the entire landmass, some of the most fertile agricultural land anywhere on Earth. If you were designing a continent from scratch and you wanted it to win, this is roughly what you'd draw up. And yet you've got Argentina defaulting on its sovereign debt 9 times. Venezuela, which sits on the world's largest proven oil reserves and still managed to leave 3/4 of its people on what they sarcastically called the Maduro diet. And then Chile, which gets held up as the regional success story, but has levels of inequality that would leave most developed nations tugging on their collars and clearing their throats. Now, there's a pattern here, and it has been repeating for so long that most economists have just quietly accepted it as a feature of the region. Except one country keeps proving us wrong. Wedged between Argentina and Brazil, it's a modest nation of just over 3.4 million people that has somehow figured out what the rest of the continent couldn't. It has the lowest corruption levels, the lowest poverty rate in South America, and a GDP per capita that doubles the continental average. Then you find out it built the first welfare state in Latin America and became the first country on Earth to fully legalise recreational marijuana as an economic strategy to undercut drug cartels. An experiment that more and more countries have since decided is worth running. That country is Uruguay. Now, it isn't perfect. It's expensive, slow-moving, and small enough that ambitious young people often leave to find opportunity elsewhere. But as a blueprint for stable, functional government in one of the most economically turbulent regions on Earth, it is arguably the most persuasive model on the continent. And look, the reason this matters isn't just that it's a nice story about a small country doing well. It's that if this model can be replicated, the implications for South America, and frankly for a lot of the developing world well beyond it, are pretty enormous. So, why has South America, despite every natural advantage imaginable, spent the better part of 2 centuries failing to build stable, prosperous economies? What did Uruguay actually do differently, and why did it work when nothing else has? And finally, can any of Uruguay's success rub off on its neighbours, and what does it mean for the rest of us if it does? When researching these videos, we spend countless hours reviewing sources and articles. Most of the time these sites are safe, but when you hit the wrong link, everything can change and all your data can be stolen in an instant. That's why I use Surfshark. It's a VPN, a virtual private network that encrypts your internet traffic and hides your real IP address, keeping anyone from ever getting your information. But it can do much more than simply protect you. Surfshark allows you to switch digital locations, enabling you to access content from around the world. But that's not all. My favourite feature, CleanWeb, blocks all pop-ups so you can stay focused on what you're doing. And if you want to take this to the next level, they also offer Surfshark Search. This is a totally ad-free browser that delivers only the information you actually want to see. Right now, Surfshark is offering Economics Explained viewers a special deal. With our code, you can get 4 extra months for free. Go to surfshark.com/economics or use code economics at checkout to get 4 extra months of Surfshark VPN. South America has tried everything. Left-wing governments, right-wing governments, military dictatorships, fragile democracies, nationalisation, privatisation, and yet the same cycle of boom, debt and crisis keeps showing up regardless of who is running things. That's because the problem was there long before any of them. When Spanish and Portuguese colonisers landed on South America, the plan was simple: take everything you can and ship it home. Gold, silver, sugar, timber, whatever could be extracted and sent back to Europe was fair game. The entire economic architecture of the continent was designed to funnel wealth upward and outward, not to circulate it among the people actually living there. The clearest example of this is the encomienda system. Under it, the Spanish crown granted colonisers the right to extract labour and tribute from indigenous populations in exchange for, supposedly, protection and Christian education. In practice, it was forced labour with a paper justification. Entire communities were put to work in mines and on farms for the benefit of people who had just arrived from across an ocean. The encomienda was eventually abolished and those colonial empires are long gone. But the rules they wrote about who owns the land, who has access to the court system, and who gets to vote didn't leave with them. So the system changed shape, but the institutions didn't. Areas with the highest colonial land concentration still show lower income and weaker state capacity today. In Colombia, Chile, and even Uruguay, 3 of the more stable and developed countries on the continent, the top 1% of households still own around 40% of total wealth. Brazil's original land was divided into enormous slices in the 1530s and handed out to the Portuguese king's personal acquaintances. Today, more than 500 years later, those areas still have land concentrated in fewer hands and governments that spend less on their populations. If the unequal institutions weren't enough, South America also inherited an economy built almost entirely around digging things out of the ground and selling them. Countries where raw materials make up more than 60% of everything they export have commodity dependence. And incidentally, every country in South America clears that threshold. Every single one. That matters because commodity prices spike and collapse, and take entire national budgets with them when they do. But the volatility itself is only half the problem. When copper prices surge or oil revenues flood in, governments spend. They hire, subsidise and build. For a while, everyone is happy, which is all a government on a 4-year cycle really needs. And when prices fall, as they always eventually do, the spending doesn't stop, because by that point entire populations depend on it. And because no politician has ever won an election by taking things away from people. So, deficits balloon, debt accumulates, and then comes the part that nobody votes for. The money runs out and the people at the bottom pay the price. That sequence is what economists call the commodity cycle. And in Latin America, it has played out so many times that it has become almost predictable. In the 30 years between 1971 and 2000, there were 20 coups across Latin America, 451 political assassinations, and 217 riots. Now, it's easy to assume the instability was caused by the debt or the inflation, and those things didn't help. But the deeper driver was the inequality that was already there, baked in since colonial times. The commodity boom of the 2000s briefly looked like it might finally break the cycle. China's appetite for South American raw materials drove nearly 5% annual growth for a decade. Poverty was cut by more than half and a new middle class emerged. Leaders from Brazil to Bolivia declared that this time was different. It wasn't. When commodity prices fell sharply after 2014, growth across the region fell to almost zero and the gains of an entire decade started going into reverse. At that point, it was hard to argue with the economists who had been saying all along that this is just how things work down here, that the structural forces at play are too deep and too old to be meaningfully reversed, that the best you can hope for is managing the cycle rather than breaking it. And for almost every country on this continent, they're right, but not all of them. Guess which country clears the 60% commodity dependence threshold by a wide margin, with more than 80% of everything it exports coming from raw agricultural goods. It's a country that has inequality and has been through its own debt crises. It has faced many of the same problems as everyone else, but it started from a slightly different place. Yes, you guessed right. When the Spanish first arrived in Uruguay in the 1500s, they found no gold and no silver, but they did find fierce indigenous resistance. So they left. For almost 100 years, the territory that would become Uruguay was largely ignored, fought over occasionally by Spain and Portugal, then by Argentina and Brazil, but never fully claimed or controlled by any of them. When Europeans finally did settle in significant numbers, they came mostly as cattle ranchers and immigrants from Spain and Italy, not as colonial administrators building extraction machinery on top of an existing population. By 1860, more than a third of Uruguay's population was foreign-born. The encomienda system never took root here the way it did in Peru, Bolivia or Brazil, and the colonial institutions of extraction were shallower. Now, none of this made Uruguay rich or stable. Through the 1800s, it lurched through civil wars, coups and the kind of elite political infighting that was standard across the continent. But the foundations were different. So when a man named José Batier Ordóñez became president and decided to build something on them that nobody else in the region had ever tried, it actually stuck. Between 1903 and 1915, across 2 terms in office, Batier y Ordóñez built Latin America's first welfare state. The 8-hour working day came in 1915, decades before most of Europe had gotten around to it. Education became free and mandatory, old age pensions, unemployment insurance and public healthcare arrived within a few years. And the logic behind all of it was that a population that is educated, healthy and not desperately poor is one that can actually participate in and contribute to an economy. Uruguay decided to invest in that population before asking it for anything in return. Batier y Ordóñez even took on the Catholic Church, separating it from the state and banning crucifixes from hospitals in 1906, just to make the point. Now, it's worth being honest. These reforms were slow, imperfect, and sometimes contradictory. Some of the labour protections actually pushed wages down in the short term, and the decades that followed were messy. There was economic stagnation in the 1950s and 60s, a military dictatorship from 1973 to 1985, and a devastating crisis in 2002 that came close to wiping out everything that had been built. Uruguay had spent years positioning itself as the stable banking haven of South America, the place where Argentines kept their savings when they didn't trust their own banks. When Argentina froze its deposits in December 2001, those same Argentines rushed to pull their money out of Uruguay instead. Within 7 months, deposits had fallen by half and the peso had lost more than half its value. On July 30th, 2002, the central bank declared a bank holiday for 4 days. In a country that had fed the world with its beef and cereals, 1 in 10 Uruguayans was now relying on state aid to eat. But Uruguay didn't collapse into the political chaos that would have been almost guaranteed anywhere else on the continent. Instead, it restructured its debt, floated its currency, rebuilt its banking system, and by 2003 was growing again. By December 2006, Uruguay had cleared its remaining IMF debt, 4 years ahead of schedule. 4 years after being on the edge of collapse, the country owed the fund nothing. Now, today, Uruguay ranks 17th globally on the Corruption Perceptions Index, the least corrupt country in the Americas. It's one of only 2 full democracies in Latin America, together with Costa Rica. Between 2016 and 2022, Peru had 7 different presidents. Uruguay had 2. And the transition between them was peaceful and orderly, which in this part of the world is itself remarkable. But the president who did more than anyone to put Uruguay on the global map was someone who had, before taking office, spent 14 years in a military prison. Much of it in solitary confinement so extreme that he survived by befriending the rats in his cell. Pepe Mujica was released in 1985 when democracy was restored, and rather than disappearing into bitterness, he went into politics. By 2009, this former Tupamaro guerrilla was elected president of Uruguay. And what followed was one of the more surprising presidencies in modern political history. But before we get to that, there are some stories that don't fit into a full video. So, we launched a weekly newsletter to cover them properly. It's interesting, genuinely important stuff, like what a $12 combo meal reveals about inflation, or whether prediction markets are just gambling dressed up in a suit. It goes out once a week, it's completely free, and the sign-up link is in the description below, or scan this QR code on screen now. If you're the kind of person who watches a video about Uruguay's economy and thinks, I want more of this, it was made for you. Now, back to Uruguay. Mujica's 5 years in office were, by the numbers, a remarkable success. Poverty fell from 18% to under 10%, and the minimum wage more than doubled, outpacing inflation. He also made an argument about what a government is actually for. He refused to live in the presidential palace, continuing instead to tend to his small flower farm outside Montevideo. He drove himself to work in a 1987 Volkswagen Beetle and donated 90% of his presidential salary to charity. When the international press called him the world's poorest president, he argued they had it backwards. He wasn't poor, he said, he was free. The truly poor were people trapped by the compulsion to consume and accumulate. And if you think that's a bold thing to say in an interview, he went to the Rio Earth Summit in 2012 and said essentially the same thing to a room full of world leaders. Politely, but directly. His presidency also legalised abortion, same-sex marriage, and recreational marijuana. Each reform was controversial, but in Mujica's framing, it was just a government looking at what was actually happening in the real world and designing policy around that. The marijuana law makes the point best. Uruguay's cannabis black market was worth tens of millions of dollars a year, all of it going to drug cartels. Mujica's argument was that if the state controls the market, the cartels don't. So, in December 2013, Uruguay became the first country on Earth to fully legalise recreational marijuana at a national level. The opposition complained and international bodies pushed back, but it worked. Now, Uruguay today is not a utopia. Crime has risen, particularly in Montevideo, and the fiscal deficit that grew during Mujica's presidency forced his successor to raise taxes. The cost of living is high, sometimes higher than parts of Western Europe, and the job market is small enough that ambitious young people still seek opportunities elsewhere, which is the contradiction at the heart of the whole story. A country that built a life worth staying for, and still can't quite keep people from leaving. And yet, despite all its problems, Uruguay has found a way out of the boom, debt and crisis cycle. Something that most of its neighbours have spent 2 centuries failing to do. Which raises an obvious question. If a small country with no oil, no mineral wealth, and a history of civil wars and military dictatorships managed to build the most stable, least corrupt democracy in the Americas, why hasn't anyone else copied it? The easy answer, the one you hear a lot in Brazil and Argentina, is that Uruguay is just too small. 3.5 million people, and more than half of them living in the capital's metro area. So it's easy to govern, easy to build consensus, and easy to maintain institutions when everyone more or less knows each other. Now, that argument is not entirely wrong. Small size does help, but it is also a very convenient excuse for doing nothing. El Salvador has 6.4 million people, Paraguay 7 million, and neither of them has managed to build anything resembling what Uruguay has. Others say Uruguay is homogeneous, that its European immigration history made it culturally cohesive in a way that its neighbours aren't, and that cohesion is what makes the institutions work. This argument drifts into ethnic determinism and oversimplifies Uruguay's ethnic diversity, but it gets repeated enough that it's worth addressing. Afro-Uruguayans make up around 10% of the population and have faced persistent discrimination and economic exclusion. Uruguay is not a monoculture. It never was. So, what actually explains why the model hasn't travelled? Well, let's be honest, some of what Uruguay built can't be copied. The shallower colonial institutions established as Uruguay's starting advantage aren't replicable. You can't go back and unbuild the encomienda system in Peru or undo 500 years of concentrated land ownership in Brazil. The path dependence of those institutions is real and it matters. But the thing is, most of what Uruguay actually did doesn't require a specific population size or a specific colonial history. The proof that left and right governments can transfer power without dismantling each other's work can be copied. So can investing in people before demanding returns from them. But these efforts require political will and time, which admittedly are two things that are in very short supply in most of the region. And yet, when Uruguay figured out how to generate nearly 99% of its electricity from renewable sources and halve its energy costs in under a decade, its neighbours noticed and said they wanted to follow suit. Uruguay has no oil, no coal, no natural gas to speak of. For most of its history, that was a serious liability. In dry years when the hydroelectric dams ran low, the country had to import fossil fuels and the cost overruns could hit $1 billion, roughly 2% of GDP for a country this size. But everything changed when a particle physicist named Ramon Mendez-Galan wrote a plan to fix it. Uruguay had a lot of flat, windy, largely uninhabited agricultural land and no domestic fossil fuels. So his plan was to cover the grasslands with wind turbines, build the grid around renewable sources, and stop sending money overseas for oil. The president read the plan and called him up. Mendez-Galan became National Director of Energy, and in under a decade, Uruguay went from regular blackouts and imported oil to generating nearly 99% of its electricity from renewable sources. Part of what made that possible was that Uruguay's electricity grid was already state-owned. There were no private companies to lobby against the plan and no shareholders to protect. The state decided what the public good required and built it. Uruguay runs its power, its water, and its internet the same way, as public utilities rather than profit centres. It's not the cheapest approach, but when the government decided to transform the grid, nothing stood in the way. Mendez-Galan himself argues this model can work anywhere, that the only thing standing between most countries and energy independence is the willingness to change the rules. And energy is just one example. There are other lessons Uruguay figured out that have nothing to do with being small or lucky, and that the rest of the continent could try tomorrow if it wanted to. For starters, Uruguay demonstrates that a welfare state and a stable democracy are not separate projects. Around 90% of Uruguayans over 65 have a pension, there is public healthcare, unemployment insurance, and cash transfers for families who need them. It's not cheap and it's not perfect, but when people's basic needs are covered, politics tends to calm down. Secondly, Uruguay shows institutions only work if people feel they belong to them. Uruguayan politicians get stopped at ice cream shops. Almost everyone is part of a party, a union, or a neighbourhood club that has some connection to the state. So it's very hard to steal from people who can see you. Uruguay's third lesson, which might be the hardest to export, is that political civility can be an economic policy. Every time a government burns down what the previous one built, decades of institutional investment go with it. Uruguay has transferred power between left and right governments for 40 years without that happening once. Even Mujica and Sanguinetti, who were enemies in an earlier life, wrote a book together in their 80s to make that point to a younger generation. And the last lesson is something Uruguayans call doing things a la Uruguaya, which means slowly and deliberately. They do referendums and debates and more debates until everyone is tired of talking about it and the reform finally passes. It's frustrating. Investors complain about it constantly, but once a change gets through that process, it sticks. Governments don't come in and spend their first year undoing everything the previous government did. Now, let's imagine South America actually learns from this. The continent has 5.5% of the world's population. It has the farmland, the water, the minerals, and the geography to be one of the great economic engines of the 21st century. Instead, it has grown at an average of about 1% a year for the last decade, the lowest growth rate of any region on Earth. The global economy has benefited enormously every time a large developing region has stabilised and grown. When East Asia developed, hundreds of millions of people lifted out of poverty, becoming consumers, producers, and investors. New industries and supply chains emerged, creating new demand for everything from cars to medicine to education. The world got richer because East Asia got richer. South America has been waiting to do the same thing for 2 centuries. It has everything East Asia had and more. What it hasn't had is the institutional stability to get there. If that changes, even partially and slowly, a genuine middle class will emerge. Not the fragile kind that appeared in the 2000s and then evaporated. A real one. People who have something to protect will start building, investing, and spending, and domestic markets that barely exist today will start to grow. Countries that spent 2 centuries digging things out of the ground will start making things instead. For the rest of the world, that means new trading partners, consumers, and new investment destinations that aren't one crisis away from collapse. And on top of all of that, the continent is sitting on something the rest of the world is going to need very badly. The global energy transition requires lithium, and more than half of the world's known lithium reserves are in South America, mostly in the Atacama Desert across Chile, Argentina, and Bolivia. It also requires copper for electrical infrastructure, and Chile alone accounts for more than a quarter of global supply. A growing global population also needs food, and the continent has some of the most fertile agricultural land anywhere on Earth, with water to match. If the commodity cycle keeps running, those resources get extracted, create instability, and the world ends up with less of what it needs than it should. Uruguay has 3.5 million people. The lessons it has spent a century learning are available to the other 430 million. Whether they take them is, at this point, a choice. Now, Brazil is probably the most dramatic version of this story. The 9th largest economy on Earth, sitting on extraordinary natural wealth with a middle class that spent a decade growing and then watched it all go into reverse. It has been on the verge of becoming a genuine global power for about 50 years, and it's still on the verge. We've made an entire video unpacking it. You should be able to click to it on your screen now. Thanks for watching, mate. Bye.